Good morning and welcome to the ParkBridge Wealth Management Winter Webinar Series. This program is entitled Overcoming Estate and Elder Care Planning Hurdles. As always, my name is Jonathan Shenkman. I'm the President and Chief Investment Officer of ParkBridge Wealth Management. In that role, I serve in a fiduciary capacity to help my clients achieve their financial objectives. The goal of my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 or so events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. And you can read my work in a variety of periodicals, including Barron's, CNBC, Forbes, Kiplinger, The Wall Street Journal, and Trust and Estates Magazine, to name just a few. You can see all my work on my website at parkbridgewealth.com/articles or by following me on social media at Jonathan on Money. Additionally, you can check out my weekly podcast, which is also called Jonathan on Money, and you can listen to that on Apple, Spotify, or wherever you get your podcasts. Additionally, I published my first book, D is for Diversification, ABCs of Personal Finance, which can now be purchased on Amazon or at jonathanonmoney.com. Before I introduce our speaker, please pay close attention if you are an attorney or a CPA in Connecticut, New Jersey, or New York and are taking this program for credit. I'll be giving a code during this program that you'll need to write down. There will only be one code. It will be given at some point in the middle of the program, so have a pen and a piece of paper ready. After the program, you'll receive an evaluation form where you'll need to insert the code in order to receive credit. Please stick around until the end of the program for further instructions on receiving credit. Today, we're privileged to hear from Elizabeth Forspan, managing attorney at Forspan Klear based on Long Island, New York. Elizabeth practices in the areas of elder law, trust and estates, and taxation. She regularly assists clients in achieving their Medicaid planning goals in a tax-efficient manner through practical and considerate planning techniques. Elizabeth speaks throughout the United States on various aspects of elder care planning, tax law, and estate planning. She has also been featured in New York Magazine, Market Watch, and has been quoted in the New York Times prior to co-founding Forspan Klear. Elizabeth was a managing attorney of a leading elder law and trust and estates law firm. She also served as a tax manager with Ernst & Young. Today, Elizabeth will be speaking on overcoming estate and elder care planning hurdles. And with that introduction, I'll now turn the program over to Elizabeth.
Jonathan, thank you so much. It's an honor, as always, to be here today. Today, we're going to be doing a little bit longer than we normally do, which is great. We're all going to get our CLE or CPE or whatever that credit is that Jonathan has been giving out, which is phenomenal. And so we have almost an hour, and then I turn into a pumpkin, so I'll stop. It's great to be here with you all. I see on the attendees a lot of my friends. That was just to pump up the numbers. I'm sure they logged in. A lot of my clients. So hi to everybody. I'm not going to call you all out by name, but it's great to see that you're all here. All right, folks. So I am so inspired by Jonathan, who is an author of a children's book, and I've been thinking maybe I should write a children's book about estate planning, but it's kind of like a little morbid and freaky. But that's actually what we're going to talk about today. Not writing a children's book, but overcoming those hurdles, right? That's a big thing. We have people who come in or people who don't come in. And why don't they come in? Why don't people come into a trust and estates attorney's office? Why do they push it off? Well, I'm not going to give it away because then I would have nothing to talk about for the next hour, but we're going to talk about that. And we're going to talk about how we as professionals can help our clients overcome those hurdles. And I will give you a little bit of a Medicaid update. There are some actual major changes taking place in New York that most people don't know about yet. So it's kind of hot off the presses. So if we get to it, and we will, I'll go over them. All right. So let's jump into it. First, I have to make sure I'm able to get my slides to work. There we go. Here we go. Okay. So I always like to start with this slide so we know what we're talking about here, right? So when we do estate planning, there are 5 documents that everybody should have. That's a power of attorney, healthcare proxy, living will, a will, and for most people, a trust. Not everybody needs a trust, but more and more, I am recommending trusts to my clients, not just irrevocable trust, but also revocable trusts, and I will explain why. So just very briefly, just as a recap, Power of attorney, what I like to call the single most important planning document, and I do mean that for almost all of us. The power of attorney is where we appoint someone to make financial and legal decisions for us, right? Why do we need this? God forbid if we become incapacitated and we cannot make decisions, legal, financial decisions for ourselves. We want to make sure that there is someone who can step into our shoes and make any decision that we would have made. Any decision. What do I mean by that? I mean, not just going to the bank, not just writing checks, although and paying bills, that's very important. But I also mean making sure that your agent under the power of attorney has the ability to change your beneficiary designations. I know that's scary. Open up new accounts for you, purchase different products for you, invest your assets, make gifts and transfers of your assets. That sounds crazy. Why would we want to empower somebody else to do that? Well, let's say, God forbid, you're incapacitated and we need to do some Medicaid planning or try to get our loved one on to Medicaid. Well, how do we do that if we don't, quote unquote, get rid of the assets, right? We have to be able to take the assets and divest ourselves of those assets. Well, if we're incapacitated and we have nobody appointed to make those decisions, and with that power, with that authority, then we might not be able to apply for Medicaid unless our loved ones petition the court to be appointed as our legal guardian, which nobody wants. I've done many, many, many guardianships in court, and they are very unpleasant to say the least. So not only do we want all of our clients and ourselves and our family members to have a power of attorney, we want them to have a great power of attorney with the ability to create trust, amend trust, revoke trust, exercise powers of appointment, purchase life estates, enter into real estate transactions, make gifts, change our beneficiaries, TOD, etc. That's the type of power of attorney that we want. Healthcare proxy, we all know what that is. We want someone in place to make healthcare decisions for us if we become incapacitated. The healthcare proxy would only come into effect upon the incapacity. Living will, some people want it, some people don't want it. That's where some people say that if, God forbid, you're in the persistent vegetative state, that you would not want to be kept alive, or maybe you do want to be kept alive forever in a vegetative state. Most people don't. I won't share with you my own wishes, but I think you will pretty much pick that up. And then, of course, the will, right? Everybody needs a will. A will is very important. It is not only where we say what we want to happen to our stuff when we die, it is also where we say that if, God forbid, we die and we have minor children, who we would want to be the custodial guardians of those children, who we would want to manage the money. So many of us have significant life insurance policies, or maybe leaving significant assets to children. You can't leave assets to a minor, so you need to appoint a trustee to manage money for the minor. Now, the will is also incredibly, incredibly important if we have a beneficiary, a child, a grandchild who has a disability, right? If we have a grandchild or a child with a disability and we're leaving something to them in our will, we want to make sure that whatever we leave to them is in what? A supplemental needs trust. When you do a supplemental needs trust in your will, that is a third-party supplemental needs trust. It is not the type of supplemental needs trust that Medicaid will be able to attach, or that the Social Security Administration will be able to attach. But it's very important, because if we leave assets to an individual who is disabled, who's on government benefits, if we leave it to them directly, that could create a huge problem for them, because if they are in receipt of a means-tested government program, like, for example, Medicaid or SSI, then by receiving an inheritance, it could make them ineligible for that. So we want to make sure that we have a supplemental needs trust in all of our wills. Why all of our wills? Meaning, even if you do not have a family member who has a disability, who is not on government benefits, why would you want to have a supplemental needs trust in your will? Because we don't know who might have a disability or need government benefits when we die, right? It could be, God forbid, our spouse, who we're leaving everything to, let's say, might have dementia, God forbid, or might be disabled in some way, that they're receiving SSI or Medicaid. And we want to make sure that if we leave anything to our spouse, that our will says that if someone who is a beneficiary hereunder, a beneficiary of our estate, is disabled, has a chronic and persistent disability, that whatever asset we leave to them, their inheritance is protected in this bubble of the supplemental needs trust. So every will Every single will that your clients, every one of your clients, should have a supplemental needs trust in their will. It's super important. And folks, every single trust that we do, every single one of your clients who has a trust should have a supplemental needs trust in the trust. I know it sounds crazy, but it's true. And we've used it and we've seen it so many times. We hope that it won't happen to us and it won't happen to our clients, but it's true. And we need to make sure that we have that. Now, there are various types of trusts. Do all of our clients need trusts? In the olden days, like last year, I used to say, nah, not everybody needs a trust. But now I have to tell you, I am doing so much as a trust administration, estate administration, right? What does that mean? Someone dies and we are administering their estate, whether it's an administration proceeding or in a probate proceeding, right? A probate proceeding is when someone dies with a will. An administration proceeding is where someone dies without a will. I'm doing a lot of this now. And what I am seeing is that the probates are not only taking a long time, but what we have to understand is that if we create a testamentary trust, if we create a trust in our will, right? I leave everything to my 5 children, let's say. I don't have 5 children. I leave everything to my 5 children, but it stays in continuing trust for them. Why do we leave everything in continuing trust for our children? So that their inheritance will be protected from creditors. It'll be protected in case of divorce, in case of a predeceased child. So we create a continuing trust for our children, which I recommend. I absolutely recommend. Why not? Well, if you do that in your will, then your will have to be probated. And in the state of New York, okay, which is where most of us are, and in many other states, not only will the will have to be probated, but what we're going to have to do is get what's called letters of trusteeship for all the trusts that are created in our will. Great. Letters of trusteeship, just like letters testamentary, say, okay, the trustee who you name in your will is now empowered to be the trustee of your testamentary trust, the trust that's in your will. What's the problem, particularly here in New York? I've experienced this in my own family. Every 6 months, letters of trusteeship go stale. And you need to go to the court. Well, not necessarily physically, but you need to go to the court and you need to get updated letters of trusteeship. So if you die and in your will, you create a trust for your children, right? Ongoing, continuing trusts that will exist until your children die. Every 6 months, their trustee, who might be them, right? We can have them be their own trustee in certain circumstances. Every 6 months, for the rest of time, they will have to go back and get updated letters of trusteeship, like I have to do for my grandmother. My grandmother died in 2009. She should rest in peace. What she did, or what her attorneys did, were they created a testamentary trust, a trust within her will. My father and my aunt, trustees, the trusts. And guess what, folks? I have to go to the court every 6 months and get my dad and my aunt updated letters of trusteeship. So we don't want to do that. So why are we talking about this? Because nowadays we could avoid it. How do we avoid it? We create a inter vivos trust, and a lifetime trust. Instead of doing a will, although we always need to have a will as a backup, and I'll talk about that, we do a trust, a revocable trust. And the revocable trust, whatever's in the revocable trust, will never need to be probated. This is very important, folks, right? I've been asked to speak a lot now on trust administration, estate administration, and probate because people are doing the planning, but they're not thinking about what happens at the end of the day. What happens when the person actually dies? If you have a trust, whatever's in the trust does not have to be probated. And so when the person dies, nothing has to go through the court. And forever and ever and ever, with the continuing trust that you do for your children in your inter vivos trust, the lifetime trust that you do, never have to go to the court to request permission or letters of trusteeship. So folks, more and more often, even for those of our clients who are not doing advanced or sophisticated planning or Medicaid planning or estate tax planning, who are not doing slats and irrevocable trusts, even for those folks, more and more, we are doing revocable trusts. I love them now. I used to not, but now I do. All right, folks, moving on. Estate planning stumbling blocks. This is what we're here today to discuss. I got to tell you, I don't know what the numbers are, but a huge percentage of us do not engage in an estate plan. I know this because more and more often people are coming to me and asking me to help with the administration of somebody, a loved one's estate. And I say administration because the person dies without a will, right? They die without a will. They die without having ever done any estate planning. And why is that? It's so easy. It's inexpensive. It's obvious. Why are people not engaging in estate planning? Well, we know the answer, right? We could put it into Chat GPT or AI and find out why. First of all, people are scared of talking about death. Nobody wants to talk about death. Nobody wants to die. I mean, there are some people who want to die, but they have other issues. Most people do not want to talk about death. They don't want to think about it. So they avoid planning. Because obviously, when you do planning, you got to think about what happens when you die. A big issue that I see is that people don't want to discuss their family dynamics. Every family has issues, okay? Every single family. We all know this, whether we admit it or not. We all think that it's our family who puts the fun back into dysfunctional. We think it's our family that's dysfunctional. Well, guess what? Everybody's family is dysfunctional. People don't want to talk about the dynamics, the family dynamics. They don't want to talk about the fact that they might have a child who is disabled. They don't want to talk about the fact that they might have a child who has a substance abuse problem. So obviously, if you do your estate planning, you need to talk about this. Although some people, even when they're sitting in the chair, when they're sitting at the conference room table with us, you could tell that they're avoiding talking about something. And what our job, as those of us who are estate planning attorneys, our job is to push. Even if it means that we might lose that client, our job is to push. If we see something, if we get the sense that there's something there, we have to push to find out what it is. Another big reason, unequal inheritances. There are going to be certain circumstances where people will need to leave unequal inheritances to their children, but they don't want to talk about it and they don't want to make that decision. So they avoid doing the planning altogether. Cost, right? People think going to a lawyer, doing a will, doing a trust, doing a deed, transferring your house into the trust, et cetera, is going to cost a lot of money. And it will. It will cost something. I'm not downplaying it. It costs money, right? You got to pay the lawyer. We got to pay the county clerk to file the deed. There's going to be a cost. So a lot of people say, you know what? I'm just not doing it. Lack of knowledge. Okay? Lack of knowledge. People, you would be so surprised. They do not know what happens to our estates and to our assets when we die. The biggest thing is my spouse gets everything. So what do I have to do anything for? Right? My spouse will decide. My spouse gets everything. My wife, okay. Obviously, that's not true. And then the other issue that I see is just plain old procrastination. And we are all guilty of this. Now, on the elder care planning side, there are some additional stumbling blocks, right? There are additional hurdles that we have to overcome. First of all, the fear of incapacity, fear of dementia, the idea of it, Alzheimer's or other forms of dementia. By definition, when you engage in elder care planning, and it's easy for, Jonathan and I, we're in our 40s. Oh, Jonathan, I don't even know if he's turned 40 yet. It's easy for us to talk about this stuff, right? It's like, that's so far away, right? We could talk about it. But for most of our clients, it's not that far away, right? The idea that we might need help with their activities of daily living, that is not that far away. And it's scary, okay? It is a scary, scary prospect to think that we might need help. We might need some elder care. help at some point. I mean, I spoke to a woman yesterday and she said to me, she's like, "Oh, I'm never going into a nursing home." I said, "Okay, Linda, I know you're never going into a nursing home, but what if you do?" She said, "My children know, Elizabeth, I'm never going in." I said, "Okay, Linda, okay. What happens if, God forbid, you have a stroke and you're hospitalized for the stroke and you lose your ability to walk or you lose your ability to, on half the side of your body, or let's say you fall and you're hospitalized and you're in the hospital and you forget how to walk and then you have to go to rehab and then you have dementia." I said, "What happens then? Are your kids going to come into the nursing home and take you home even though you can't go home?" I said, "These are real things," but she didn't want to talk about it, right? She didn't want to face that reality that this is something that happens to so many of us. So people have a real fear of talking about incapacity, a real fear of talking about aging. Again, family dynamics, but now a little bit differently. Which one of my children is going to take care of me? I think about this all the time because I only have boys, right? And, I made the mistake of not having girls. So are my boys going to be able to take care of me, right? It's a real thing. You have to have a girl to take care of you. I hope with God's help, I get good daughters-in-law. My kids are very, very little, but of course, I'm an elder law attorney, so I think about these things. Which of my children will take care of me? Will my children have my best interest at heart? Who am I going to be able to trust? Folks, people don't want to think about this. They want to put their heads in the sand and pretend like everything is great, right? That's it. Cost, another stumbling block. Cost. Okay. People don't get long-term care insurance. This is an unbelievable thing. I can't understand this. I have had long-term care insurance since I am 34 years old. You might say I'm crazy, and I am, but not for this. Long-term care insurance is so important and so beneficial. And I know you might think that that's weird to hear from an elder law attorney whose job it is to help people who don't have long-term care insurance or who don't have enough long-term care insurance. But the reality is I see this at the end of the day. I see this when mom and dad are going into the facility or when mom and dad need help at home. The long-term care insurance is key. So many people who can qualify for it do not get it. Now, nowadays, people are not getting those old policies, the use it or lose it policies, which are amazing. Those Genworth or there's John Hancock or nationwide policies where it was like $600 a day or $700 a day, no maximum. When I see that, it warms my heart. Most clients don't have that. And many clients who I talk to who are in their 50s or early 60s who are in good health, they say, "No, I'm not getting it. It's too expensive." That's a mistake. Because nowadays you can get a life insurance policy. This is what I have. This is what I got from my dad. You could get a life insurance policy with a long-term care rider that's built in, and you could use the long-term care component. If you don't lose it, there might be a life insurance component left over for your children and for your family. Why not just look into it? Okay. You'll be surprised. It's not as expensive as you think. And trust me, the cost of not getting it is far greater than the cost of getting it in so many circumstances. I know I sound like an insurance salesperson. I have sent many people to Jonathan who has helped my client. He's helped so many of my clients with not just their planning, their asset planning and their financial planning, but also with this, because this is a huge component. This is a huge component of asset protection planning and financial planning, right? Because if you don't do the insurance, or if you don't do the Medicaid planning, which we're going to talk about in a second, you're going to draw down so significantly on your savings to pay for care, right? We'll talk about that in an upcoming slide. Medicaid planning. Oh my gosh. People say, "I'm not going to go to a lawyer. I'm not going to do my Medicaid planning because it's going to cost me $4,000 or $5,000 to do a trust." Okay. We'll see in a upcoming slide the cost of not doing the Medicaid planning. right? Medicaid planning is for those who already have long-term care insurance, or excuse me, who don't have long-term care insurance, or who have long-term care insurance, but it's insufficient, which unfortunately, folks, we see a lot. People come in and they say, we don't need to do the planning. We have a long-term care insurance policy. Well, yesterday, my friend Linda said the same thing to me. She said, Liz, I don't have to do it. I have long-term care insurance. I said, okay, your long-term care insurance pays $600 a day if you're in a nursing home. And she said, no. I said, what does it pay, Linda? 200 a day? She said, yeah, it's like 225. I don't even have the long-term, the inflation rider. I said, Linda, a nursing home costs $600 a day. What are you talking about over here? Right? She was 80 years old and she can't get she can't get additional insurance at this point. And she thought that she was okay because she had the long-term care insurance. Well, guess what? She's not okay because she has long-term care insurance that's going to cost a third of what the cost of care is. Okay, lack of knowledge, just like with estate planning. So many people are unaware of programs that are available. They're unaware of Medicaid. They're unaware of the long-term care insurance. They're unaware of the veterans benefits. So many of our clients are veterans and they get veterans, but they could qualify for better veterans benefits and they just don't do it. And then procrastination, right? What do I always tell people? When is the best time to do Medicaid planning or elder care planning, right? Well, unless there's like some, health consideration, the ideal time to do it is in the mid to late 60s, right? Why do we say mid to late 60s? Because we have the 5-year look back, which we'll talk about. Well, statistically, if you're in your mid to late 60s, you'll have the 5 years. You'll be okay. You'll be healthy for 5 years. So you could do the planning and then let the 5 years go and your assets will be protected. Well, folks, how many people that are in their mid to late 60s actually come in to do the planning? Not that many. Most of the time, it's people in their late 70s, early 80s, late 80s, early 90s, mid 90s, late 90s. You'd be very surprised. I had a woman come in just recently, God bless her, and she's great, 99 years old. The husband's 98. It's amazing. They came in, nobody had a walker, nobody had a cane. They drove here themselves. Uh, Very unusual. But she said, okay, I'm ready to do my Medicaid planning. And it was great. And we took care of her. We helped her, and it was wonderful. Procrastination, folks. A lot of procrastination. Jonathan, you want to give a code?
Yes, thank you. Perfect timing. I just want to interject here briefly before we continue. For accountants and attorneys who are taking this program for credit, please write this down. The code is G41. Again, G as in gold, the number 4, and the number 1, one final time. G41. Back to you.
Did you do G41 because I'm 41?
Yeah, that's exactly. I try to coordinate with the credit
Yes.
people. Yeah.
Yes, yes. Very good. Very good.
Yeah. Yeah.
Okay. Thank you, Jonathan. We'll move on. Maybe by the time people listen to this, I'll be 42. Although we have a few months to go, Okay. Procrastination, we talked about. Now, brass tacks. Let's talk about brass tacks, people. How do we overcome these obstacles? Well, we could do it bluntly. We could talk about it bluntly with our client, or we could do it nicely and gently. For me, it depends on the mood that I'm in. No, I'm just joking. Normally, I think one of the things that I'm known for is that I can do this in a kind and sweet and gentle way with our clients. And I advise all of you who are dealing with this with your clients to do the same. Folks, everybody's going to die, right? We're all going to die. Hopefully, we live a long time, but we're all going to die. And we need our clients know that. We just have to help them remember that. And we have to help them remember that dying without a plan will mean that you're not deciding what happens when you die. Somebody else or something else, right? Maybe your kids, maybe the state, somebody else, maybe the court. Somebody else is going to decide what happens when you die if you don't make these plans now. And that's not what anybody wants. There's nobody who wants the court to decide what happens to them if they become incapacitated, and there's nobody that wants the court to decide what will happen to their estate when they die rather than deciding it themselves. If we really put them to it, if we really put the question to them. Now, when it comes to people who have minor children, you can't roll the dice, right? You gotta have a will. This is the most important thing for young people. You know, and when I say young people, I mean people who have young children. It's astounding to me that people do not do their wills when they are expecting their first child. That's when I did my will. When I was 27, 28 years old, I was expecting my first baby. And that's when my husband and I did our wills. And I don't even think that maybe I was already in the area of trust and estates at that point. I think I was. Um, that's when we did our wills. That's when we really bulked up our life insurance. Um, you gotta you gotta do it, and your clients have to do it because if you don't decide who will be the guardian for your minor children, if God forbid something happens to you and your spouse, or in the case of someone who doesn't have a spouse, if something happens to you, you are saying, I want a judge who I've never met, who may not even be a judge right now, maybe just a regular, idiot like me, right? I want that person to decide who's going to raise my children if something happens to me. It's crazy. If we would all understand that, then we would all have wills. So I think that this is like something that we need to discuss not only with our clients, but with our own children who may have children, right? I tell this to most of my clients are elderly. I mean, I have quite a bit of younger, clients in their 30s and 40s, but most of my clients have grandchildren. And I say to them, have your kids done their planning, right? Have your kids decided who's going to be the guardian for their kids, right? It's so important, and it's astounding how many people have not done this. So that's just something I want to just, put out there to everybody. Folks, we have to explain to our clients that estate planning is a lot more than just death, right? It's a lot more than who gets our stuff when we die, right? If we don't engage in our estate planning, might there be a large estate tax when we die? People think there's not going to be an estate tax. There's so much misinformation out there, right? People think, oh, I need to have $30 million in order for there to be an estate tax. Well, that's not true, because if you live in New York, right? If you live in New York, the estate tax exemption currently, right, 2026 is $7.35 million. Once you hit 5% of that, your entire estate is taxed, right? And so what that means is that if you have some young clients or some clients who have a life insurance policy and a house, their estate might be subject to an estate tax, a New York estate tax. So estate planning is just so much more than just the will and what happens when we die. We have to explain that to our clients. We have to discuss incapacity, advanced directives, gifting, etc. The fear of incapacity, dementia, talking about it. Okay? It's real. We talked about this. It's very, very real. And we need to understand that about our clients. We need to understand that we do this every day, right? We talk about dying and death every single day, but our clients don't. And so we need to be very, very sensitive with them about this, okay? We need to say, I understand how you feel. I understand how you feel. By the way, guys, I never really understood how my clients felt until I sat down and did a new healthcare proxy. I don't remember when this was, but when I had to sign my healthcare proxy, it was like, oh my God, might I become incapacitated at some point? Might there be somebody else who's going to be making health decisions and medical decisions for me? This is freaky. So actually, maybe the best way to understand our clients is to maybe revisit or renew our own planning. It's an interesting idea that I just thought about. But we need to sit down very gently with our clients and explain, look, a lot of people land up with dementia. I mean, it's the reality. We see it in our own lives. We see it with our parents, our grandparents, with our friends. I mean, there are young people that have dementia. It's a terrible, terrible thing. We don't want to talk about it, but we have to, because I always talk about my mom. She should rest in peace. She always used to say, she had great sayings. I mean, really great sayings. One of them was that we hope for the best, but we plan for the worst. Just because we're doing this planning doesn't mean that we're not hopeful people, optimistic people, and we should be. We should all live with hope and optimism. It's actually a really good thing for us emotionally and physically. But we need to talk about the consequences of not doing the planning. Because if we become incapacitated, we have to have our clients understand that if we did not do our advanced directives, if we did not do a healthcare proxy and a power of attorney, then what's going to happen is that somebody is going to have to petition for a court-appointed guardian to be appointed for you. And the court will decide. Your family members may fight. I have been engaged as an attorney in many contested Article 81 guardianships in the Supreme Court where kids or other family members or other stakeholders in the person's lives are fighting to become the guardian, and it is incredibly expensive. It tears families apart, and guess what? Guess whose money is going to be used? Your money. At the end of the day, 99% of the time, the court is going to say that all the fees for all of this is going to come out of the pocket of the AIP, the alleged incapacitated person. When you do, we have to tell our clients that when we make a plan for incapacity, that is a gift to them. That is a gift to their children. We're taking the decision away from the children. We're making the decision now. Most of us are parents, and we know we want to do everything to protect our children. We'll do this, give them this gift. Okay. Family dynamics. People don't want to talk about this. Drug abuse, substance abuse, alcoholism, disability. Almost every family that comes in, almost every couple has this in their lives. Okay. Whether they say it at first or not, when we tease it out of them, mental health issues with the kids, alcoholism, unfortunately, it's there. It's there. Child may have a disability that's not obvious, right? Maybe it's a bipolar disorder. Maybe it's an intellectual disability, and people don't want to talk about it. They're very nervous to talk about anything with anyone outside the family. And frankly, they don't even discuss it between spouses. It's just like, let's put our head in the sand and let's make believe it doesn't exist. It is a very, very difficult discussion to have with your clients. It's a difficult discussion for your clients to have. And we need to approach that with sensitivity. But we need to address it head on. And what we explain to the clients, and I find that this really helps, is that every family has issues. You are not alone. We all have issues. And sometimes I talk to them about the issues in my own family, and believe me, there are many. Every family has issues. And this is why, folks, AI is never going to be able to replace us. I mean, I hope I don't eat my words, but AI will never, as advanced as AI is, and believe me, it is. Oh my God, you can have conversations with Alexa and with Siri. It's incredible. But they are never going to be able to. AI is never going to be able to do this planning with people with this type of sensitivity and tease out the issues. I know a lot of estate planners and financial planners are worried about AI, but frankly, I'm not. It's because of this. We need to address it, as I mentioned, with sensitivity. And there are ways that we can help our clients and say, look, I know you might have one kid who has these issues, but we're going to do a continuing trust for all of your children, right? When you die, every one of them is going to have a trust for the inheritance. And that, you'd be surprised, that makes them feel a lot better that they're not singling out one of their children. Okay. A big issue is unequal inheritances. Sometimes there is a real desire to leave an unequal inheritance to our children, right? You may have one child who is a hedge fund manager and has more money than you could ever dream of. And then another one of your children is a school teacher, right? And so you know inside that the school teacher is going to need a lot more, or could benefit from, we shouldn't say need, could benefit from a lot more when you die. And so you know it, but you're scared because when they go and they read the will, and folks, there's no real reading of the will, but when they read the will, they're going to see that you left nothing to the hedge fund child, managing child, and everything to the school teacher child. And the kids are gonna think like, well, did mom and dad, did they not love me? Right? Or did they not love me as much? Because that's oftentimes what's gonna happen. And so I think that we need to discuss this with our clients and help them figure out how to do this if they want to do it. If they listen, some clients, many clients, in fact, most will say, I don't care. It's going to go equally to each one of the children. But we can help our clients figure out a way to do it where it's not so obvious. It's not in the reading of the will, right? Maybe they have a beneficiary designation to one child and not to the other, and it's not obvious. It's not in their face. Maybe they put that child as a joint account holder with them on some of their accounts. Of course, we have to be very careful if it's a brokerage account not to lose the basis step up. But like on a bank account, for example, when we're not worried about a basis step up, maybe that's where we do it. So there are ways to do this, and we have to approach it with sensitivity with our clients. We need to get down to the bottom of what do you mean by unequal, right? What does unequal actually mean? Sometimes unequal is still equitable. So we need to do that. So, that's an important discussion. Okay, cost, and then I'm going to get into a little bit more technical stuff that I think is very important for today. When the clients are worried about cost, we have to explain to them, and it's oftentimes not us, the estate planners, but it's the accountant or the financial advisor or somebody else in their lives who has to explain the cost of not engaging in the planning will be far more costly than engaging in the planning. If you fail to engage in your estate tax planning, you may be leaving your kids or your beneficiaries with a very large estate tax problem. If you fail to engage in elder care planning, you may be saddled with a huge cost for long-term care, right? A nursing home could cost $20,000 a month, and that's not a crazy number. Whereas you might spend $5,000 or $6,000 on a lawyer to do a trust and a deed and to do your whole estate plan. That's a quarter of what 1 month in a nursing home will cost. Home care is going to be over $10,000 private pay. If you need 24/7 care, $10,000 a month. It's $120,000 a year. If you would have just gone and done your plan for $5,000 or $6,000, maybe you could have avoided all of that, right? It's a tiny cost when you look at it in comparison to the cost of not doing the planning. So engaging in the planning, lifetime intervivos planning, is going to save your heirs or your children a lot later on. Clients need to understand that. Lack of knowledge, right? I thought my wife gets everything. Guys, knowledge is power. CPA, financial advisor, they need to say, look, that's not how it goes, right? If you become incapacitated, your spouse is not going to be able to manage your IRA. Your IRA is not a joint account. You need a power of attorney. You need your spouse to be your power of attorney or someone else to be your power of attorney. And you need to have a successor power of attorney, a successor agent if something happens to your spouse, right? Because an IRA is an individual retirement account. There was nobody else on it. So there's no joint account holder who could transact. You need to have the power of attorney. If you die without a will your spouse get everything? Well, if you're in the state of New York, no. Your spouse will get the first $50,000. and then 50%, and your children will get the other 50%. Well, what if that 50% that's going to your spouse is not enough to provide for them? Problem. So people need to understand that your spouse doesn't just get everything. That's not how the rules work. You need to plan for that. And we need to explain to our clients that there are programs out there. And we need to explain to our clients that one of the biggest misconceptions is that Medicare pays for long-term care. Medicare does not pay for long-term care. People think Medicare will pay for a nursing home or will pay for home care. It does not. Medicare might pay for up to 100 days in a rehab after you're hospitalized for a minimum of 3 days, or maybe it won't. Maybe it won't. It doesn't pay it every time, right? If they've determined that you've plateaued or that you're not getting any better. Medicare does not pay for long-term care. Clients don't realize that. We have to explain it. Okay. Communication, be open, have a family meeting, maybe some families' family meeting is not good. You, as the professional, have to understand that and help your clients work through that. Maybe leave a letter to your loved ones and say, look, my wonderful son, you've managed that hedge fund so beautifully. I'm so proud of you. I love you so much. And I love you as equally to all our other children, but you're a billionaire, so I'm not leaving you anything. But I hope that you know that I love you. Okay? I'm simplifying it, but sometimes a letter to your loved ones that explains everything is a good thing, right? Some attorneys say don't do it. It's going to lead to litigation, this, that. Please, okay? As a professional, as an attorney, we'll take it case by case and explain it to our clients. Okay. I am going to skip this slide, although it's extremely important. I spoke about this, I think, last year, but we just have to understand that as we do our Medicaid planning, our elder care planning, there are a lot of tax considerations and there are a lot of estate planning considerations. Sometimes they don't all go together beautifully, but we could make them go together beautifully. So we have to be very careful. We know what the gift tax exemptions currently are. We also have to understand that just because the annual gift tax exemption is $19,000 per donee, that doesn't mean that that's okay for Medicaid, because if you apply for Medicaid, they're going to look at all transfers you've made within the last 5 years, probably transfers of $2,000 and above. What I want to talk about very briefly is give a little bit of a Medicaid update. Now, this has the new numbers, okay? And we can all see what the numbers are, how much money you can have in order to apply for Medicaid, $32,000 for an individual, $43,000 if both members of the couple are applying for Medicaid. If you have anything in excess of that, you're not going to be eligible for Medicaid, with an exception, with a couple of exceptions. Sometimes your home will not be counted if you're living in it and the net equity value of your home is under $1 million. This is New York, folks. And a retirement account. Now, folks, this is a very big change and a very big thing I want to talk about. It's pretty much hot off the presses. It just came out at the end of December, but everybody was busy with the holidays and the new year and kind of went over a lot of people's heads. We have some phenomenal news in New York, and I really don't know how this is going to play out. In New York, you can have $1 million in a retirement account, in an IRA, and still be eligible for Medicaid. This is crazy. It used to be, until a few weeks ago, that well, actually, let me say this again, because this is new. I'm processing it myself. If you have a retirement account, it's exempt as long as it's in payout status. Now, payout status, what does that mean? Well, it used to mean that in New York City, in the 5 boroughs, you were getting your minimum required distributions. If you got your minimum required distributions, the IRA was an exempt asset. Medicaid did not count it towards that $32,000 or $43,000 number. Okay. In Nassau, Suffolk, Westchester, every other county, Medicaid had their own life expectancy tables. And in fact, you had to take out a lot more than the RMDs in order for the asset to be considered exempt and not countable. Well, folks, at the end of December, New York State issued a GIS, a General Information System, that said, as long as it's in periodic payout status, the IRA is exempt and not countable. but it did not have to be in maximum payout status. It does not have to be in maximum payout status. So the way I am reading this now is, let's say you're under 73 and you need Medicaid. Well, you don't have to do the MRDs because you're under 73. The IRS only says you only got to take it when you're 73. Let's say you're 69. What if you put your IRA in payout status where you get $1 a month from your IRA? Does that mean that the entire IRA is not countable? I am sure that Medicaid will come out with more guidance on this, but the way that I read it now, right, in early 2026, is that as long as it's in some sort of a payout status, not maximum payout status, the IRA will be exempt. This is tremendous news, because what that means is that people will have to pull out so little from their IRAs, which means that they're going to have a lot in it to leave over. So they're going to be able to be on Medicaid. They'll be on Medicaid, to be eligible for Medicaid, but only be taking out their minimum required distributions, right? Let me say it like this. Most of our clients who are receiving Medicaid are above the age of 73, right? That's, unless there's some major health issue or early onset dementia, they're going to be over 73. So they will, under the IRS rules, need to take out their minimum required distributions, but they will not have to take out this huge amount they previously had to take out every month in order to be eligible from a Medicaid perspective. So this is huge news. There is nothing on the 30-month look back yet. Right? We know that there is a 5-month, excuse me, I wish it were 5 months. There is a 5-year look back for nursing home care. So we got to transfer our assets to a trust, not our retirement assets, transfer our countable assets, our house, potentially our brokerage account, money in the bank, not everything, put it in a trust, wait 5 years, then we're eligible for nursing home Medicaid. But there's no look back for home care in New York, which is incredible, because basically you could transfer your assets to a Medicaid trust or a trust on January 30th, and then by February 1st, or even January 31st even, and then on February 1st, you're financially eligible for Medicaid from a home care perspective. It's an amazing thing. There's supposed to be a 30-month look back for home care that they have now pushed off. It's going on almost 6 years now, the implementation. So we have to always keep a very close eye on that, because that will be coming soon. And what that means is that for our clients like Linda, who I mentioned earlier, who will never go into a nursing home, right? She says she's never going into a nursing home. None of us want to, but for home care, our clients still need to be engaging in this plan, because we can't, at some point, we're not going to be able to do it at the last minute. Okay. And this is the regional rates in New York, which I'm not going to get into because it's a complex discussion, but this is how we calculate the penalty period for the 5-year look back. I want us to always, when we do the Medicaid planning, when our clients do the Medicaid planning, we have to be very cognizant of the tax issues, right? Are we giving away money? Are we giving away assets? If we're giving away assets, are we doing it directly to our children? No. First of all, it's stupid to do that. But second of all, we don't want to give them a carryover basis. We want to make sure that there's a basis step up when we die. How do we achieve that? We put it in a trust that has a state inclusion, a trust where it will be a completed gift from a Medicaid perspective, but an incomplete gift from a tax perspective. We want to make sure that we're going to get the basis step up. Okay. Maybe the trust says that the grantor is entitled to income. I don't like that. In most cases, how we're going to get around this is we're going to have the grantor retain what's called a limited power of appointment, the ability to change the beneficiaries of the trust. That will bring it back into the estate for tax purposes. So whatever we put into that trust is not going to be a completed gift. We will be able to get the basis step up when we die. Very important, particularly for our homes, which have, of course, a very, in most cases, most of our clients' homes have a very low basis. Okay. And folks, that is all I am going to talk about today, although there are a lot more slides here. Some of you have seen many of these slides before. The requirements of Medicaid trusts and how we have to be careful about it, what we could put into a Medicaid trust, what we shouldn't. how we maintain our $250,000 exemption, even if our house is in a Medicaid trust, right? From the sale of the principal residence. If you transfer your house into a Medicaid trust and then you decide to sell it, will you still be entitled to the $250,000 or $500,000 exemption from capital gain under Section 121A of the Internal Revenue Code? The answer is if you do it properly, if you draft that trust properly, and you live in the home, then yes, you will be able to. And all the different types of liquid, non-liquid assets, we would transfer potentially a non-qualified annuity. Can it be transferred into an irrevocable trust? Yes. Got to be careful. And we need to understand the rules on non-qualified annuities because folks, even though we might not think that's the best investment, so many of our clients have them when they come in and talk to us. Okay, folks. Well, Jonathan and everybody, it's been a pleasure. It's been an honor as always. I hope I didn't put too many people to sleep today. Of course, my email address is on this last slide and my phone number. Best way to reach me is, of course, email. For those of you who have Brandy, my assistant's email address, please CC her because that's the best way to get through to me. I'm kind of old school. She prints out my emails. We go over them at the end of the day. But I'm going to try to respond to as many questions that come in via email. So thank you. Thank you so much, Jonathan. Turning it back over.
Great. Thank you so much, Elizabeth. If anyone has any specific questions, new business opportunities, or any other issues they'd like to discuss, please feel free to reach out directly to Elizabeth or myself where appropriate, and I'll be sure to include her contact information in the follow-up email to this program as well. Four more quick items before I let you go. First, and most important, later today you'll receive an email from me with an evaluation form for the program. I'll ask you to input the code that I mentioned here today in order to receive your credit. After that is submitted, in the coming days, you'll receive an email from ACE Seminars with your certificate. Again, please keep an eye out for an email from ACE Seminars. If you don't see that email in the next few days, be sure to check your spam folder. Again, the email with your certificate will not be from me. It will be from ACE Seminars. Second, my next webinar is on Thursday, February 12th on Escape from New York, Tax and Estate Planning Considerations for Moving to Florida or Israel, featuring Lawrence Garbuz, who's a partner at Lewis Garbuz based in New York, and Boaz Feinberg, who's a partner at Arnon Tadmor Levy based in Tel Aviv. I'll be sure to send out the invitation to this program in the coming days. In the meantime, if you have a friend or colleague who would like to be notified of these webinars, they can email me with the word webinar in the subject line. My email is jonathan@parkbridgewealth.com. Third, you can follow me on all my work on X and Instagram at Jonathan on Money, and by connecting with me on LinkedIn. You could also listen to my weekly podcast called Jonathan on Money, which is available on Apple, Spotify, or wherever you get your podcasts. And you can watch my practical planning videos, which I post several times a week by following me on YouTube at Jonathan on Money as well. And fourth, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. I thank you in advance for that. And with that, this concludes today's session. Please stay safe and healthy and have a wonderful day, everybody.